My name's Glen Macdonald. I'm the moderator. I work here in town at Hillview Capital Advisors, which is my day job, and by night I run an organization called the Wealth and Giving Forum. We've been convening folks of wealth for a decade and helping them to explore how to deploy their capital to make a difference for the causes and communities they care about, which is why I'm really happy to be here today, because that's kind of going to be a continuation of conversations I've been having over the past decade on this very topic. And we've seen a dramatic shift, and I think you're going to hear it in the panel today, from families just being content with what was classic charitable giving or philanthropic endeavors, and the exploration of how they can use more of their wealth and their core portfolios to change the trajectory of some of the social challenges that we all are very much concerned about. So I'm delighted that we have four very experienced but also very different type of commentaries that will be put forth today by our panelists. And let me just introduce them briefly, starting the back end, Hendrik Jordaan from Colorado, CEO of 1001 Voices, originally from South Africa and made his way to Colorado through SMU, correct?
Correct.
Michele Demers, who's founder and CEO of Boundless Impact, a very new initiative. But despite its newness, Michelle's not new to this field, having worked with the Aperio and Foundation Source, and brings that depth of knowledge to bear upon what she's doing. Alexandra Peterson, who's the founder and co-CEO of Madeira Global. Co-founders of, they leave off the CEO title, of Madeira Global, and comes from a family that has a history of being philanthropic, and she's going to share that story with us, and we're excited about that. And Ken Lassner works for Aperio, which is a fund company that does indexing around SRI and ESG, and he's going to offer a perspective both on how he sees that market evolving both with private investors and how the large financial institutions that he services are starting to realize that this marketplace is real. So with no further ado, I'd like to start with Alexandra and ask you the question, or share with us your journey to Madeira Global. I know you come from a family that's very well known. Your grandfather, having served in government, done well in the business world, and then had the capacity to be philanthropic, and you're kind of born into that. And then you had your challenges in the nonprofit world and in Madeira Global. Please share that with us.
Sure. Hi, I'm Alexandra. I am the co-founder of Madeira Global. We're an impact investment and advisory firm. So I was raised in a very philanthropic environment. It was a big priority in my family, and so it was a very natural inclination to sort of dive right into that after college as a full-time job. When I was in the nonprofit world, my personality didn't necessarily meet all of the characteristics of a nonprofit, and I really liked for-profit structures. I thought it was really interesting, the sustainability and scalability of them. So while I was working, I was sort of I was looking at nonprofits as sort of one part of my life and then the for-profit as the other, and I was frustrated by the dichotomy of that I felt the need to split those two worlds and not be able to sort of engage with those structures simultaneously. So that's really where my interest came into alignment with impact investing, that I think it's sort of the perfect confluence of finance and philanthropy, and that's been really wonderful for me to be able to jump into that through Madeira, which we started about 3 years ago. My business partner, Christina Alfonso, is here. And really, I think that's a very exemplary journey of a millennial. Millennials today are, there are 80 million of them, born between 1980 and 2000. We are the largest generation in history, and grew up in one of the most global environments. So millennials were raised with, in an internet generation, exposed to major events, the AIDS epidemic, Nelson Mandela getting elected, 9/11, the Iraq War, Occupy Wall Street, the Arab Spring. There's a lot of information that we've had access to over a great period of time through very, very early age, and we've been immersed into it. And I think that one of the reasons why everybody's seeing millennials sort of jump into this space with open arms is because of that access to information, that through digital technology, you're able to hear people's personal perspectives from across the world. Right? You get to see these incredible journeys up close as if you know them. So I think that all of a sudden you have a generation that feels as if they've been a part of so many of these events in history that are incredibly important and influential, and that challenges and determines their perspective of the world. And millennials have been called many, many things, many of which are very negative, disrespectful, coddled, narcissistic, way too aggressive. I apologize for selfies on the behalf of my generation. But I think also the characteristics that I just laid out, those negative characteristics, also bring on some really fantastic qualities as well. So it's a disruptive generation. It's aggressive, very risk tolerant, taking initiative. They're sort of not scared of challenges, and I think that's really wonderful. And I think that's part of the reason why so many are jumping into this very challenging area at a really young age. And given the events that we've all witnessed and felt so close to, even if we've never actually been to the region, I think it gives you a perspective that the supply chain is global, and you can touch it and feel it and see the consequences now like you've never been able to before. And because of that, I feel responsible to make decisions that are not just financial, but also that have social benefit. And because of that, I think impact investing is a huge, will be a huge industry over the next couple of years. I mean, Forbes just put out a study that said that 71% of millennials seek to incorporate social responsibility into their day-to-day lives and will choose socially responsible companies over non-socially responsible companies. So it'll be really interesting to see what happens over the coming years.
So before we turn to Madeira Global and your work there, I'd like to, hearing you talk, I reflect on, sadly to say, I'm old enough to remember the 60s and in the early 70s, and there was a large group of college students around the country and around the world that were protesting against establishment and going to places like Woodstock and talking about love, peace, and self-actualization. And came back and got jobs at Wall Street, and then created a kind of a mess from time to time. I know you mentioned that the internet and digital technology allows for connectivity, that allows for these movements to maybe sustain themselves in ways they didn't back then. But have you reflected on what may be different this time relative to those that trend that kind of faded, back in because we could say about that generation that they also were looking to create a new world and change the world, but it didn't happen.
I think there could be a variety of reasons. I think the job market is definitely a way for people to consider or reconsider what they want to be doing with their time, their priorities, and forcing people to think from a different perspective. It's a different kind of world. Opportunities are in certain ways far more vast and in others squandered. And so I think that being raised in systems that have been outwardly called broken has brought in sort of a new wave of sort of the impassioned young generation. I also think that Accenture put out a study that they think $30 trillion is going, over the next several decades, is going to move from baby boomers to their heirs in North America alone, right? That's a great deal of purchasing power. And I think that sort of empowerment, for lack of a better word, is going to really change the way that people take a look at their own investments and decision making.
Great, thank you. So tell us about Madeira Global. When we spoke on the phone, you talked about helping individual investors and families create mandates about what they wanted to do with their money, and then live within those mandates. And so tell us how that's going and what some of the challenges are as you engage with families, and what's working well.
Sure. So we started the company working with families and helping them align their social objectives with their investments. And we believe that impact investing, so an investment in a for-profit company that aligns with social benefit, is very much a philosophy. And so that philosophy is personal per family. So helping these families align their personal objectives in the social space, and helping them navigate through this world, which can be complicated. I think that some of the challenges that come with doing something so tailored to a particular perspective is that you have a great deal of research that needs to be done, a great deal of due diligence. You have it takes a lot of time, and not everybody fully understands what they want to do immediately, right? So it's a long journey for many families. What's worked really well is that we're now more focused on creating products and strategies that have social alignment within their for-profit structure, and that seems to be a better way to facilitate capital into that part of the world or that industry.
As you develop products, and I might ask you to share an example of what one product may look like. Could your advisory shift in terms of, right now you're customizing each solution for your individual clients, but as you develop product, would you be tempted to want, a lot of, any family that comes to Madeira Global for advice to be part of that product, even if it's not aligned with? There's always the pressure when you develop something to have people come into it, if you know what I mean, which is the classic challenge that we all face in the financial services industry. So I just wanted to know if you're feeling that tension as you move forward at Madeira Global.
So we are moving away from some of that advisory work and more into the products and strategy side, just as to be able to facilitate capital into impact investing. We think that this is a really great way to do it. An example of one of the strategies that we put together is a short duration strategy. I think a lot of opportunities have long lockup periods for capital, 7 to 10 years. Previously, people are used to that through the private equity and venture capital world, and we were looking for opportunities that might be more palatable for investors, particularly since this is a nascent industry, to have people sort of slowly move in and feel like they can make an investment without having it be a large burden on them. So a short duration fund, I think, is a great opportunity.
So it's helping your clients test it.
Well, I think it's a strategy for some, and other ways that people who are looking to experience impact investing for the first time, this is something that I think that they would be willing to do versus such a long commitment. And do you have a sector or geographic focus, or? We are focused on sort of 6 different areas, which include sort of industries where there is obvious impact, or one can construe obvious impact. So, infrastructure, employment, renewable energy, education, healthcare.
And tell us about the profile of some of your investors. Are most of them your fellow millennials, or are you dealing with multi-generational families?
Absolutely multi-generational. We work with qualified investors, and the family offices in particular are those who generally have a philanthropic initiative of sorts. But that doesn't necessarily mean that philanthropic philosophy is going to be the same as their impact. But I think definitely, millennials are very eager and open to generally an impact investment, whereas potentially, older generations are more traditional philanthropists. I and my own family have this heated conversation quite a bit of the belief that you make as much money as you can, and then from there at age 70 or whenever you've accomplished that particular number, you then give it away. I think younger generations, at least in my perspective, very much want to integrate those two worlds, and so being able to have conversations with an intergenerational lens, I think, is really important, because older generations are still making the majority of decisions for that capital, and so being able to put it into perspective for both those who are incredibly open to it and then those also who are more familiar and comfortable in the traditional philanthropic approach, to be able to sort of move them slightly into the impact world, you have to have a soft touch.
So I remember when we spoke on the phone, I asked you, so with all the things you can do, because you have some access and many available opportunities for you, why this? Why is this so important to you? Why are you doing this?
For me, I think it is a necessity and not an option. As I mentioned, being a millennial, growing up with all of these different events that have taken place throughout my lifetime, seeing them, I think it's crucial that we all of a sudden start to pay attention to the supply chain, that we use our purchasing power for good, because there are issues with our natural resources, there are issues with human rights, and I don't think we can ignore it any longer. And once you have the information, I think it's very hard to forget it. So for me, being able to incorporate the two is very much a way of life versus sort of a happenstance choice.
Great. Thanks, Ali. So Hendrik, I've had the pleasure of getting to know Hendrik over the past several months, and I think the story he probably shared yesterday, I would like him to retell today about John Corr's epiphany, so to speak, is really compelling. We see it more and more in philanthropic families, of the challenge of, well, as you tell it, the lines growing at a foster home in Africa. So tell us that story again, even if you've heard it, because I think it really does set the tone for what is shifting in the minds of even later generation philanthropists that philanthropy alone maybe won't get the job done.
Certainly, glad to do so. Thank you, Glen. Thanks for having me. What became Coors Brewing Company, which at one point was the largest brewery in the world, was started 4 generations ago by a German orphan who was a stowaway, a German orphan who snuck into a boat, made his way across the United States, somehow ended up in Golden, Colorado, and with an $18,000 private equity investment from a businessman in Denver called Mr. Schuler, started what was Schuler and Coors, and ultimately became the Coors Brewing Company. Several generations later, John and Shauna Coors have adopted 6 children. They have 4 of their own. Really a remarkable family. 6 adopted kids from all around the world. Remarkable family. John and his family have been going to Africa for 20 years. They have built orphanages, schools. They have clothed, fed, and cared for children. They have educated them along the way. And John shares the story that what broke his heart was when he saw these talented young entrepreneurs and potential executives, well educated, ready for the workforce, not have a job. He also tells the story that he went to, him and his members of his family set up a temporary dental care facility in Kenya. The intention was to, for a couple of days, provide basic dental care, abscesses in teeth and the like, expecting 300, 400, maybe 500 people to show up. Lo and behold, 5,000 people showed up. After 3 days of working around the clock, the team ran out of medical supplies. And John had the obligation to physically shut the gate on 4,000, 3,500, suffice it to say, a very large number of people who'd been waiting for basic dental care. What he realized was that philanthropy, whilst it has its place in civil society, without a question, and performs certain noble and appropriate functions, is not the right tool that over a long period of time can create the jobs that are needed and can truly lift people out of poverty. What is needed is free enterprise, but not, call it unbridled free enterprise, not a pure pursuit for only profit. Instead, what we call values-based investment. That really was the birth of 1001 Voices, and that resulted in John looking new at different models to say, how can we really move the needle on poverty around the world? What he concluded, which I 100% concur, is that the tool, if you would, the weapon of free enterprise, is a very powerful weapon that could be used in the fight against poverty if it's wielded the right way. Further, it's not simply free enterprise. It's more than that. It's the world's leading families that have behind them not only the financial resources, but much more. Relationships, insights that collectively can do more than any single family can do. That's our belief. That's what's is John's story, and I'm privileged to be a part of it.
That's great. So, Hendrik, as you've gone out to other families and talked to them about this model, what's been the receptivity to it? And tell us a little bit about the conversations you're having with them and how they're embracing or not embracing this model.
What's remarkable is, I believe we're at a very interesting point in history. I think we're at a time, we alluded to this a little earlier, where there is more awareness of not only consumers but also ultra high net worth families around the world of their, you could call it obligation or responsibility, you can call it an opportunity to drive transformative change. And what I have witnessed unequivocally, Glen, is that there is mounting frustration with the lack of outcomes that a lot of philanthropy has had. A lot of activity, not the outcomes that many families desire, not the sustainable growth that many families desire. When we announced the formation of 1001 Voices at the World Economic Forum in Cape Town on May 8th, 2013, I received a series of emails from families literally around the world. And some of these are some of the most prominent families, for example, in Europe, that reached out, sent an email to info@1k1v.com. That's our stock email. Literally stating along the lines of, to whom it may concern. We read with keen interest the article in the Wall Street Journal talking about how leading families are coming together to use free enterprise done well to drive positive change in the world. We're intrigued. We'd love to learn more. We've seen that response echo not only in the United States, but really echo around the globe. So there's without a doubt a groundswell of change that families, and like consumers and like millennials, have come to realize.
So, the leading families of the world, one challenge is that the organization sits in an elite position, and by staying in that position doesn't invite more capital, and to have this model become systemic below that wealth level. I know of your conviction and commitment to this, and I've not met John, but I'm sure from what I've read and what I know about him that he's serious. But how does 1001 Voices, as it visions out over the next decade or so, see this as something that's replicable, not just for the leading families of the world, but for the rest of us?
Yeah, it's great comment, question. So we describe ourselves not as a fund but as a movement. We believe the world's greatest movements have three things in common. One is injustice, one is fear, and one is hope. And as we look at global issues facing the world, Gallup recently did a poll of 8 million people that I'm sure many of you are well aware of. And the number one concern that was raised by 8 million people around the world was not having a job. By providing jobs, not just jobs, but the right kind of jobs people can be proud of, and the right environments, so many positive externalities and changes flow. So, why are we a movement, and why are we more than, call it a fund or even simply private capital? What we seek to do at 1001 Voices is sweep in other organizations, sweep in like-minded initiatives from around the world, partner with other groups to try to drive prosperity for families around the globe. That's what we are about, Glen, at our core. We're also about catalytic change. We have ambitions not to simply deploy 300 or 600 million in Africa and drive positive change alone, although that, I would argue, is very noble in and of itself. I believe it is. But imagine if you could get 1,000 leading families from around the world aligned. Imagine if you could have 1,000 or even 100 brands represented by some of the leading and values-based families from around the globe. Imagine how you could shift conversation and dialogue with governments. Imagine how you can influence the minds and hearts and souls of people around the world for good. Where this can go is really remarkable, and that's our mission. So we have many plans, but we're starting with a little $300 million fund in Africa.
Terrific. In 10 years at the TBLI conference here, we'll check back in. Two names, Schumpeter and Piketty from France, who just wrote that book on the inequality of capitalism. And Schumpeter talks about creative destruction. So as you deploy capital, there's negative externalities that in terms of pollution, or even sometimes if the business is not going well, you got to make some tough decisions of cost cutting. How in the private equity fund are you going to deal with some of the classic challenges of capitalism that can sometimes be heartless?
Yeah. So I think of capitalism as a sword. It's a beautiful sword that could be wielded in the fight against poverty to do incredible good in the world. But that sword, as sharp as it is, if it's wielded in the wrong hands, can also do harm. Much like philanthropy. Philanthropy can do a lot of good if it's done the right way, but philanthropy, like capitalism, if it's deployed the wrong way, can create a lot of dependency and can do a lot of harm. At 1001 Voices, we practice what we call values-based investment. To us, it's self-evident when you invest that you do so the right way. To us, you always consider the environment when you invest. To us, when you run a great company that is profitable, you absolutely generate the social, when it's done the right way, the social. A great example would be Starbucks, right? You look at a company like Starbucks. When Howard Schultz set out to build Starbucks, right, he set out to build a remarkable coffee company. He was also inspired by the fact that his father didn't have healthcare. And what he built through Starbucks is an incredibly profitable business that provides more healthcare, I think, to people who work at Starbucks principally for healthcare, right? The social good that's flown from that company is, and for the coffee. Yeah, but it's incredible what good has flown from values-based free enterprise. There's many other examples around it, but fundamentally, it's not. The way I think of it, Glen, is if you take the tool of the sword of free enterprise, you supercharge it with the relationships and the intellectual capital of the world's leading families. Yet you temper it with their value sets. You have the ability to drive extraordinary good in the world.
Great. So give us one example. I know you might not be able to disclose the name of the company, but I think you just closed on a deal.
Well, I really can't comment on specifically on our deals.
But just conceptually,
Yeah.
what type of, size of company
Sure,
is generally.
sure.
And on the value question, how you when you make the investment,
Yeah,
that you ensure that ESG lineup,
yeah.
environment, social governance is embedded into the fabric of the company you're investing in.
Well, I'll start with how we selected our team, because I think a lot of it comes down to judgment and to the value sets of the individuals. The team that we have, I literally evaluated approximately 200 potential fund managers. The team we have is a remarkable team, over 85 years of investment experience in Africa. But here's how we differed and how we selected them. We selected the team not only for a great investment track record, but we also looked at the team for value sets. We put them through a full psychological scrub, if you would, to evaluate and say, all right, is this team only motivated at making money at all costs? Or is this team's value set align with values-based long-term value creation the right way, right? Taking into account environmental, social, and governance considerations out of the gate. We've woven that into our investment process from the very beginning. Let me walk you through a hypothetical example about its. I'm going to be fairly opaque because I'm under NDA on this deal, but it's actually a live deal that we're moving on. So imagine there's a manufacturing business in an industry that is otherwise struggling. It's an industry that that has the latent potential, if injected with the right capital and right influence, could grow, could become a bonfire that could spark all kinds of other jobs and change, and innovation and growth. What we will do in that case is not only drive a top return, not only create jobs people can be proud of, right? But what we'll seek to do is to transform an industry. And we'll transform an industry by bringing in some of the leading families from around the world that could rebrand an industry, and this is a beautiful story from a clean energy perspective around this opportunity. But more than that, it's putting the continent of Africa on the map in the way that hasn't been done before. It's giving rebirth to an industry that really should be dynamic and innovative and growing, but hasn't been. And again, the way we're evaluating that deal is not only on a standalone basis. Yes, we're doing that rigorously. But above and beyond that, we're considering all kinds of other relevant implications for the community and the continent. And we think it's synergistic and aligned with driving more value over the long term.
Thank you for that. A lot of good has come out of South Africa.
Especially a good rugby team
A good rugby
and some
team
good beer.
Good rugby team and some great folks. So, yeah, I guess you guys started the divestment movement many years ago. So, anyway, we want to shift gears a little bit now. We've heard from representatives of two great American families, Peterson and Poor's. And now we're going to have two service providers, different types of service providers, talk to us about what they are doing to help individual investors and families make good decisions about deployment of the capital with tools and measurement frameworks. And first, we're going to have Michele. Demers, I think you're going to come to the podium and show us a couple slides.
Yeah.
So please come forward.
Hi, everyone. Does this work? So I'm going to go through a few slides, but I thought it made sense, given these inspirational stories we've already heard, for me to tell my own story. I've worked with high net worth families and individuals my whole career, and I spent actually most of my career working in the human rights movement. And when I was recruited by Pam and Pierre Midyar to help them launch their humanitarian foundation back in 2006. Previous to that, as I mentioned, I worked in the human rights movement, and one of the main events that was sort of always top of mind working in the human rights movement was the genocide that happened in Rwanda in 1994. And how could that have happened? How could we have let that happen? How could things be different so that wouldn't happen again? And when I joined the team at Humanity United, I had worked for traditional nonprofits like Human Rights Watch, and then worked for traditional foundations like the Ford Foundation and professional style foundations. I had never worked for a venture philanthropist who was a living donor who wanted to take a very forward-leaning approach to their philanthropy. And actually, Pierre Omidyar and Pam Omidyar were impact investors before they coined the term, because when I was there, they were in the midst of transforming what was originally the Omidyar Foundation to the Omidyar Network, which was I was at Humanity United. I helped form that entity, but Omidyar Network, as it is now, and it's a 3 times bigger than Humanity United. It's a fund that actually gives, I think, 85% to private companies. So it's an interesting hybrid of a fund and a philanthropic vehicle. So. Anyway, in 2000, joined the team and helped set it up, and we set it up as both a 501c3 and a 501c4. So the 501c4 could have a legislative advocacy intent to influence policy, influence the amount of money that the U.S. Budget was going toward Africa and toward some of the places where we were working to prevent mass atrocities. And actually, we made some strategic investments in 2007 that I know were absolutely critical to preventing a genocide in Kenya around the presidential election in 2008. And that was, for me, a very aha moment. We made an investment in a technology company that actually could uses like a heat map kind of technology to essentially detect ethnic violence on the ground, kind of like satellite imagery. And then we made an investment in a global media company called Internews. And we were able to see in the radio messages that these minority tribes in Kenya were rising up, were banding together, rising up in opposition against the majority tribe, which was slated to win the presidential election. And we saw that that there was some terrible, horrible, hateful messages on the radio, which was the primary form of communication still in 2008. And we were founding members of a really interesting group of ex-diplomats called the Elders, started by Richard Branson and Desmond Tutu and Nelson Mandela and many others, group of ex-diplomats that go into intractable conflicts and to try to help resolve them. And from that group, Kofi Annan went to Kenya when we heard about these other developments, and was able to go there early enough to do some shuttle diplomacy between the tribes and diffuse the violence and the tension. And so we've never heard of the genocide of Kenya in 2008 because it didn't happen. And for me, that was a life-shifting moment. That really changed my perspective. And I really wanted to move my career more into, I guess, what I call the business of philanthropy. But it's really, how do we make philanthropy, and how do we take the power of capital and generosity, and how do we make it, how do we make the world a better place? So I created Boundless, and Boundless is all about trying to bring truth and transparency to the impact investing sector. And we're doing it by doing sector-specific research for families, high net worth individuals, family offices, and private wealth managers. And our whole focus is that there needs to be more granular research on the social impact side in order for investors, private investors, to feel comfortable taking risk and making investments. That's how we're going to unleash the capital. So, so my main presentation is about essentially talking about how important private investors are. So private investors are key to building this new phenomena called social impact investing. And there's a lot of talk about the importance and the role of institutional investors, and they certainly are very important. But it's my belief that private investors are leading the effort. And I'm going to show you a few facts that just sort of support that. So if you look at the last, gosh, I guess it's 50 years since the 60s. Well, where's time going? The private foundation market in the U.S., so this is the data we got. There's private foundations popping up all over the world, but we're looking at the U.S. in this chart. Look at the growth, and that growth is only going to continue to go up. It's enormous. And in the last decade, 40% of these were created. You've got just a completely new perspective, just as Alexandra was talking about. Philanthropists are not, they're not thinking the way they used to. It's not just about writing a check and feeling good. People want to focus on results. They want their investments to be guided by research, by strategy, by evidence. And they're concerned about social returns, but they're also concerned about financial returns. They don't want to see their money going down the drain or being wasted or being squandered. And so this is another chart that's sort of, I'm sorry, you can't see it because you're sitting right there. This is essentially just showing the size of the high net worth individual portion of the philanthropic market. So you've got a 417 billion philanthropic market in the U.S. currently. And high net worth individuals make up 74% of that, and then high net worth are half of that. So it's a huge portion of the philanthropic market. And institutions have such big voices that I don't think people always realize this. Another really interesting development. So a lot of the larger banks are losing their high net worth clients to the small family offices, to the boutique multifamily office private wealth managers. Why? Why is that? Why are people going to the boutique firms? Well, I would say it's because they want more direct control over where their capital is going. I was having lunch with Justin Rockefeller about a month ago, and he told me the story with the Rockefeller Brothers Fund. They had a wealth manager. He's on the investment committee. For those of you who don't know, the Rockefeller Brothers Fund is the main family foundation for the Rockefeller family. The Rockefeller Foundation is a professional foundation that was founded with John D., the original oil tycoon's money. The Rockefeller Brothers Fund has more than 50% family members on its board still. And Justin, who's a next gen, is on the investment committee, and he was not happy when he saw they had no control over where they were investing their endowment. And they actually ended up firing that firm and hiring another one that gave them the ability to invest in at least negative screen funds. Another interesting development. So philanthropists want to have more social value for their investment capital. And if you look at the market, that's $417 billion market, it's obviously it's very significant, but it's not actually reaching many global needs because only 5% of it is being deployed for social purposes. Most of it's tied up in foundation assets that are, like I just told you about with the RBF, being invested traditionally. So they're not going to anything social. And so investors are looking to impact investing as a way to have a more direct social contribution. And then we've been hearing about these data points on the size of the impact investing market for the last 2 days. So one estimate that we pulled up here is it could be as much as 650 billion in the next 5 years. But there's a lot of different estimations about the size of the market and what you include in the size of the market. So private investors are really driving. The other thing that's interesting is it's just a growing field of interest, and we've got a lot of interesting statistics here from a survey that was done of financial advisors that they are continuing to see impact investments grow their practices. The JP Morgan study shows that individual investors are going to impact investments are going to make up 14% of individual portfolios within 10 years. And then, of course, the last statistic about millennials, following up on what Alexandra was saying, that 29% of millennials believe values-based investing is an important factor in choosing a wealth management firm. So it's the data is there to support the growth of this sector. The problem is with impact investing, and is a lot of families are interested in getting involved in it, but it's confusing. There's a lot of different names: socially responsible investing, sustainable investing, mission-driven investing, impact investing, philanthropic investing. What's the difference? It's really hard to figure out. And the continuum is actually a little too broad and too unclear. So we grabbed this from JP Morgan. I did attribute it to them up there on the top. So you can see here, you've got kind of overlap between impact investing and venture philanthropy, and socially responsible investing and impact investing. And I think everyone's a little concerned that there's such blurry lines. I mean, the way Boundless would look to define it, and this isn't going to be the most popular thing, but we don't think socially responsible investing is impact investing. You're not having a measurable positive return when you're investing in a negative screen fund. And so we believe in the GIN definition: equity investments and loans made to companies and nonprofits with the intention of generating positive social, environmental, and financial returns, not negative screens, not SRI products. And a lot of the big banks out there are saying they're doing impact investing, and they're selling SRI products. Just want you all to know. We did our homework. So impact investing is, as Alexandra was saying, we have just what you just said is right up here. It combines the best of philanthropy and traditional investing. It's just, you've got the business rigor and the measure, the evidence, and then you don't have the negative externalities, that are with a lot of traditional investments. And I think, as Hendrik was saying, I think in a lot of sectors, and we're trying to figure out which of those sectors are the best places for investments, but there's a lot of sectors where we can actually solve social problems better than just traditional philanthropy. Philanthropy is critical and important, but in some sectors, we're just not going to be able to reach the number of people with traditional nonprofit institutions and the limitations of those structures and government. So the whole notion of impact investing is that we can make faster progress on a lot of these social problems. We can eradicate diseases. We can move countries from an aid to an economic development model. You can give young people a chance to learn and grow that wouldn't otherwise have those opportunities. And we can hopefully create new forms of energy and ways of living that aren't so destructive to our planet. So that's my presentation.
So, great. In the interest of time, I'm going to have Ken come up.
Sure.
But a question for you to be thinking about when we open it up to the floor is, if you would give us an example, think of an example of one sector you're working on, and you talk about the details of measure going underneath the surface. I'm sure the crowd would like to hear that.
Sure.
So this is a nice segue because Ken, representing Aperio, is one of the pioneering firms in screening, both negative and positive screening of portfolios. I'm not going to speak for Ken, but I would venture that he might say that negative screening, which means avoiding doing bad things, can actually be good. So to kind of create some debate with what Michele just presented, Ken, offer us your perspective. First, tell us a little bit about Aperio. Its roots were not originally in ESG, but migrated there. So tell us a little bit about Aperio as a firm. Tell us what you've seen. You and I have had the opportunity to spend some time together over the past couple of months, and I know in the past 18 months there's been you've been witnessing kind of a meteoric interest in this space. So share that with us as well. And come back with a few more questions.
Thanks, Glenn, and thanks everybody, and thanks for inviting me, filling in at the final hour. I'm happy to be here, and happy to be part of this and kind of give you my perspective, a little bit different, as Glenn was saying. But so let me quickly on Aperio Group, we manage equities for mostly for ultra high net worth families, family offices, either directly with the families or mostly through their advisors. And we also work with endowments and foundations, mostly on the ESG side, both screening positively and negatively on their equity investment portfolio. We got our start in 2000, so we've been around about 14 years, and as Glen said, we didn't get started thinking too much, as really not too many were, about screening portfolios for social purposes, but as we have been managing money and these equities for the kind of multi-generation families, we have been very responsive to what they were telling us, and that is a theme that I think we've seen kind of grown, as Glen said, tremendously, really over the past 18 months, I think is a great way to put it. So we manage $8 billion total in really custom equity portfolios, managed for taxes, managed for risk, and managed for social values. Of the 8 billion, about 1.5 of that 8 billion is what we can refer to using these terms as SRI, so socially screened in some way, shape, or form. So if we were just an SRI firm, we'd be really big in this industry. But as a percentage of what we do, it's about 20%. So we kind of have I think a unique perspective, and a couple of comments. We manage public equities, and we don't do any private. We just long only public equities, as I say, customized for clients. So the public equity market has not been traditionally thought of as a place to incorporate values, and many reasons for that, which I can get into. However, if you think about it, I mean, this is a $60 trillion market worldwide. It is extremely big. So why not, why ignore this tremendously big market? Michele brought up the point that foundations are expressing their values on the 5% that they're giving each year. And I heard I was on a committee for a sustainable investing conference at NISA 2 weeks ago, and I heard it put fantastically by one of the panelists who runs a foundation, and said, so we're giving and we're doing great things with the 5%, and we're solving problems with that 5%. Unfortunately, the other 95% of our assets are actually creating those problems that we're trying to solve with the 5%. So there's a little bit of a mismatch there that certainly can be addressed by public equities. So I'll just kind of take you, was that a good introduction? So I'll just kind of take you quickly through some of the trends that we're seeing. One of the stories I like to tell is, when I joined Aperio, and I've been with Aperio a little bit over 3 years, we were under $2 billion, 300 million or so in SRI screen portfolios, and approximately, and I work with clients, approximately 10% of the conversations I was having was about incorporating values into their investment portfolios. Now it's 50%. So, I'm a hockey player, and I love those hockey stick graphs. I mean, there's no question that this is a hockey stick graph, and congratulations to the Rangers. So yeah, the investment world is definitely changing, and we're seeing many more of these conferences, and the last bullet on that continuum slide you had talked about the mainstream, right? At some point, this will be mainstream, incorporating these type of measurements into evaluating stocks will happen. You know, you got SASB out there, so it's already happening. But we're seeing it in terms of the really tremendous impact and increase in the client focus. So the old version of SRI is, as you said, it's I just take these companies out of my portfolio and market cap weight the rest, and I'm good with that. You know, so that's things. 10 years ago, we were doing it too. A lot of doing it, eliminating like tobacco stocks or weapons manufacturers or alcohol or kind of like the sin companies. But we've come so far away from that. Now it's really what we call the new version of SRI. And our version of SRI is, we call it socially responsive indexing. So notice we don't call it socially responsible. We call it socially responsive because we manage customized portfolios, so we're responsive to what's important to our clients. So the new version of SRI is, yeah, sure, there's still the negative screening aspect of it, where we will eliminate companies that you don't want to see in your portfolio. One of the trends that we're seeing now, in addition to the traditional tobacco and all that type of stuff, are fossil fuel companies, right? So we're seeing the movement on college campuses similar to what was happening in South Africa 20 years ago. We're seeing that same movement happen, at 350 universities around the country. There have been some very public foundations and endowments that have removed fossil fuel companies, I'm talking about oil, gas, coal, from their portfolios very publicly. And if you go to divestinvestphilanthropy.org, you'll see a list of those companies, and we're working with a few of those. Stanford just eliminated coal companies from their investment, for direct investment in coal companies from their investment portfolio. So the negative is continuing to happen. But we're also seeing is the positive. So getting back to that environmental focus, it's coming from those next generation of wealth owners that are looking at their portfolios and are saying, okay, so you're screening on companies and that's all good, and maybe you're owning kind of a best in class where you might be owning Chevron instead of Exxon because they pollute a little bit less, but I don't want to see any of those companies. Okay, fine. Well, what do you want to see in your portfolio? Well, I want to see companies that are really looking to help change the world and solve the problems of climate change and things like that. So that enables us to understand what they want and then go out there and find out if there's data that we can incorporate. And in fact, there is, and create strategies that can address that. So environmental is certainly one of them. I mentioned the carbon divestment movement. Other areas that we're seeing are things like human rights, which was brought up before. Treatment of workers are important to people. Animal welfare, how are, you don't want companies that test on animals or things like that. So we just see a tremendous amount. And again, will it change the behavior of the company itself? Perhaps not. But will it make you feel better about the 95% of your portfolio and not create problems that you're trying to solve? Yes, it absolutely will. So that's a good kind of overview of what we're doing. So in terms of the investment business around this, it has become a key prospecting tool, and it's almost to the point where if you're not addressing it at the business level, if you're an investment advisor, you're going to be behind. And I've heard numerous examples of clients come to us and say, I've tried to get this addressed elsewhere, and my investment advisor is just not listening to me. I don't want to see certain types of companies in my portfolio. I want to overweight other types of companies that I feel better about. And their answer has been, don't worry about that part. Well, I think that has changed as well. And, we talk about performance, right? So we're indexers. That's where we, that's our philosophy. is basically it is very difficult to beat an index over the long term. And I'm talking about broad market indexes like the Russell 3000, S&P, MSCI World, et cetera. So our default investment philosophy is to be very, very close to the index without adding extra costs. We manage portfolios in such a way that we can minimize that extra risk of screening investment portfolios such that it will really not impact the overall performance of the portfolio by very much over the long term. Okay, so it's no longer a question of, well, you know, social screening is just a tax on performance. That is not what we believe, and it has not been our experience. And complicated really is not complicated. It's just a question of, is there data that can be used to incorporate the type of values that are important to you into your investment portfolio? And, you know, for the most part there is, and if there's not, we will tell you and say, you know, that is a little bit more difficult to address, but perhaps we can think about it in a different way. So there's many things, and again, values are personal. So we're never going to come out and tell you this is, you know, we're going to import our values onto you because this is what we believe. No, you tell us what you believe. We'll sit down, we'll have what we call a social conversation, and we'll figure out how to get it implemented.